welcome on board Mahendra Jajoo, CIO of Fixed Income, Mirae Asset Management, joining us on the show. Mr. Jajoo, give us some sense that what this 50 basis point of rate cut announcement means for the Indian bonds, because yes, Indian bond market did turn a bit of volatile post and during the announcement as well. But what will be the larger implications?
So, there seems to be a case of upfronting of the entire possibility of the rate cuts, and therefore the stance is now changed to neutral, which means that possibility of the future rate cuts are low, and that gives the market a reference point for the terminal rate in the current cycle. So, therefore, market will now expect 5.5% to be the final rate at the end of the current interest rate cycle, and therefore market can price the 10-year yield with reference to 5.5%. So assuming a spread of about 75 basis points, the 10-year yield is now quoting at around 6.25%. To the extent that RBI's stance is, or the approach is still very accommodative, they are there to support growth and stabilize the financial markets. Once they stop cutting rates, they will move to the other parallel measures like the open market operations or injecting liquidity or conducting daily life operations. So therefore, market will continue to get support. But then the 10-year yield for now seems to be anchored at around 6.25% basis the fact that the terminal rate in the current cycle could be around 5.5%.
Mr. Jajoo, this is Varun this side. I just wanted to understand the behavior of the bond yields today, because after the rate cut and CRR announcement, the bond yield went down to 6.13, but again we have seen the bond yield rising back to 6.2 and 6.22%. So what's the reason for this? How do you read that?
Yeah, so the primary driver for that is the fact that the stance is now changed to neutral. A neutral stance means that the possibility of rate cuts in quick future or immediate future is much lower. So market as a reference point. So let's say market now starts pricing the 10-year yield, assuming that 5.5% is the low of the interest rates in the current cycle. And then market can put a term structure premium. So at this point, market is telling us that, look, maybe between 50 to 75 basis points spread on the repo rate is the correct pricing of the 10-year yield. And therefore, the 10-year yield in anticipation of rate cuts was already there, right? And therefore, today the market has shown kind of a, classic display of buy on rumor, sell on facts. Now that the rate cut is there, people need to devise their next strategy. The liquidity in the market is surplus, the credit growth is slowing down, and there is a huge demand from the banks and the insurance companies and the pension funds for the longer end bond. So once the market is able to digest this huge rate cut, but with the indication of no further rate cuts, the liquidity will then push the institutional investors to invest. So I will expect the 10-year yield to inch towards the 6% level in the next couple of months.
Okay. Hi, Mr. Jajoo, this is Kanishka also joining in. I just wanted to ask you, it's been a great policy, but on the global front, especially with respect to tariffs, things do remain slightly uncertain. So what's your outlook there? How should we be navigating that?
Yeah. So insofar as the global uncertainty is concerned, in relation to the monetary policy, I think the governor spelled it out that as long as there is uncertainty on the external front, it is important to ensure that the domestic financial markets remain stable, they operate smoothly, and there is no disruption. And towards that end, they have injected liquidity more than what the market needs now. They have upfronted the rate cuts. So therefore, the global uncertainty at this point has actually helped the RBI take a more aggressive monetary policy stance. And those uncertainties are not going to go away. That will have its implication in terms of growth and the trade balance, etc. But as far as the fixed income markets are concerned, or as far as the bond markets are concerned, given the fact that inflation is at 3.5%, projected by the Reserve Bank at 3.7 actually, and that the growth is projected at 6.5%, but there is still a need for continued push to stimulate the growth, and that the global monetary policy setting is easy. Fed has been cutting rates, and this European Central Bank cut rates yesterday. The long-term rates in US have gone up because of the domestic factors, but India's macro fundamentals are very strong. So I think that is at this point, the global uncertainty is possibly acting as a tailwind for the monetary policy.
Okay. Mr. Jajoo, just wanted to understand on the bond market outflows, because of late we have seen bond markets outflows, and basically this is because one of the reason is the narrow interest rate differential between India and US 10-year bond yield. After this rate cut, how do you expect the overall inflows or outflows or the overall flows into the bond market?
No, I think the flows will continue to come because the US yields are going up because of their local factors. So US has a problem of inflation, US has a problem of a fiscal deficit, US has a problem of uncertainty on account of the trade balance, and those are the factors because of their government's current policy setup. And therefore, everyone in the world is looking to redefine the term structure, as we say, what should be the 10-year yield in US. So in US, everybody is now wanting to get out of US, at least the foreign investors. So US will have a lot of supply of bonds, but not enough demand. And therefore, the long-term rates in US are going up. As far as Fed is concerned, we have seen them cut rates, and they are indicating that they will cut rates by another 50 basis points in 2025. As far as India is concerned, the government fiscal deficit is very well balanced. Our inflation is at 3.25% now. So therefore, because the inflation differential has narrowed, India's macro fundamentals have improved. US fundamentals possibly does not show that pace of improvement, if not deterioration. Therefore, it is natural that the spread between the US yield and the Indian yields will narrow. Today, any foreign investors is going to come to India not because he is looking at arbitrage between 10-year yield in US and India 10-year yield, but because they think that the India 10-year yield has scope to ease further, and there is a very strong case for that. And
Yes.
therefore, I think
Thank you so much, Mr. Jajoo. I'm really sorry for interrupting, but it's the RBI presser that we have to head to, because RBI is just...
If you like this video, then like, share and subscribe to ET Now.